I'm Charlotte McLeod with investingnews.com, and here today with me is Rich Checkan, President and COO of Asset Strategies International. Thank you so much for being here. Great to have you.
Thanks for having me. Always a pleasure to be with you.
Really good to be speaking with you. And when we were emailing to set this interview up, you mentioned you were excited to talk about the stealth bull market in gold and silver. So I thought we could start there and learn about what you mean by that.
Yeah, so we have a bull market. There's no question about it. Gold's been moving up. If you look at the charts over the past year or so, we really got a breakout into 2023 and 2024. It's continued. So far, silver's outpacing gold this year, which is expected. But gold is still moving up. We're up in the $2,300, $2,400 range, roughly. And, there's no question we have a bull market. The biggest question is why? Because the Western investors aren't in this, right? I just give you some experiential background. I've got clients calling me up saying, hey, Rich, I'm sorry, I got to sell some gold. And like, it's your gold. You do what you want with it, right? That's fine by me. And they're like, no, I want to get back in as soon as I can, but I have to pay down credit card debt. And I don't think you recall, we talked about this last year, that I didn't think the economy was as good as maybe the Fed would, portend that it was. People were buying what they needed, but it all cost more. And as a result, they had to tap into, they couldn't tap into home equity lines like they used to do. Because now if they do that and they refinance, they're going from a 3% to an 8% mortgage. Nobody wants to do that. So they started going to credit cards. We saw, $1.2 trillion in credit card debt nearly at 29% interest. They're maxed out. That's done in terms of a source of financing for needs. And where do people go next? They go to something that's liquid. Virtually nothing more liquid than the gold and silver markets. So we're seeing selling by Western investors, both physicals, I feel that, but other retailers are feeling that. We're seeing it through the ETFs. The giant sucking sound as gold leaves the GLD or the SLV from Europe and from North America. And the big question is, where is it going? The buying is what's got to support that price. And I think it's clear it's central banks and Asian investors, maybe some private offices ahead of, private family offices ahead of the elections coming up in November.
Yeah, maybe let's talk a little bit more about where is that going? Because I've been hearing a lot just in the last month or two or three about the rise of Asian investors. And of course, we know there's a cultural component there. This isn't really a surprise, but is this something that we need to watch even more closely at this point?
I don't know that we need to watch it even more closely. You may see it tail off a little bit now because China's past their Lunar New Year, right? India is not quite to the wedding season. And that puts us right smack dab in the middle of the summer doldrums. And I think there was just news release that China had announced they didn't do any buying in May. I think they just announced they didn't do any buying in June. Yet other central banks are. And I still think, as I spoke last year, central banks are the main driver of this. They're buying because we've weaponized the dollar and we've mismanaged the dollar, the world's reserve currency. And central banks around the world are saying, hey, I'm going to shed some of my foreign reserve assets, specifically dollars, and I'm going to replace it with another tier one asset, and that's gold. And we've been seeing that. So even with China out of the game in May and June, central bank buying continues with a fervor. And that's really the main story. Gets really fun when Western investors get in this. And I'm not 100% sure what the catalyst is or when that happens, although I suspect it might have something to do with the Fed.
Right. And we should definitely make sure to take a look at the Fed. So when we last spoke, which was back in November, you had mentioned it was getting to the end of its rope. And we're still here, though, with no rate cuts. So curious to hear what you think could be coming. It seems like maybe we're looking at one this year, but that keeps changing.
I heard 3 last night when we were on the cruise. Somebody threw out 3. The Fed is at the end of the rope. They haven't done anything. So they haven't cut, but they haven't raised it either. They know they've gone about as far as they can go, right? And they haven't broken anything yet, so to speak. So there's not a wide panic. There's not a recession. The labor market hasn't, capsized or anything. So I guess they're just kind of hoping it can last a little bit longer, and they really want to get to that 2% target inflation rate, which they'll probably never get to. But they're holding out as long as they can. We got a little bit of bad news on Friday last week with the labor statistics. They were down. And that shows that maybe we're starting to see some cracking in the labor market. And that has everybody now suspecting again that we're going to see rate cuts. And that's where that 3 number came from. Some say as early as July. I don't think so. I think if anything, maybe September. The bottom line is by their guidance and their criteria, they should not be cutting rates. They should not, but they probably will, because they can't afford to finance the debt at that rate. So it is highly possible. That's why you saw a bit of a rally last week on the labor market news, that everybody's like, okay, we're back on the table again with rate cuts, even though they're saying higher for longer. I think at some point they're going to have to do something, and it may very well be this year. That probably starts to bring Western investors back into this.
Any sense from you on why the Fed has been able to hold out so long? Because, looking back to the same event last year, it felt like we were having conversations about how it was going to have to cut soon. And any thoughts there?
I think they're just lucky, honestly. I don't give them a whole lot of credit in terms of knowing what they're doing or knowing the impact of what they're doing. You know this. I've been a big critic of the Fed and the Fed chairman. Things they've said, transitory inflation, what they said last year about strong household savings and strong consumer demand. That's all garbage. They were completely wrong about transitory, came out and admitted it. They blamed it on everybody else, and really they caused it. And then last year, they were saying consumer spending and household savings were strong because there was still spending going on. What they completely missed, just like they did transitory, was the fact that, this year, whatever people need, not really wants, but needs, are 3% higher than what they were last year. Last year, they were 10% higher than what they were the year before. We're seeing the increase in spending not because people are spending more money and they're flush with cash. They're spending more because everything costs more and they need it, okay? And they're having trouble finding ways to buy it, to pay for it. I think they're just lucky. I don't think they're ever going to get down to that 2%. I don't think they know how. And I've said this before too. It's not all their fault. I'm not going to pin all this on Fed Chairman Powell and the Fed. Congress is the problem. They have not balanced a budget for years. They have no will to do so. They're not going to cut entitlements, which means that deficit will continue to grow. And at higher interest rates, that's a burden that we're just not going to be able to get out from under. Every politician, every congressman, every senator, and the presidential candidates here in the U.S. are doubling down. We're not touching Social Security. We're not touching Medicare. We're not getting rid of, this, that, or the other. They all spend too much money just on different things, but more than we take in. And Powell can't fight that. They've got to balance a budget. They've got to actually have a surplus and bring that debt down if Powell's able to do anything with the economy and the dollar.
Very, very fair points. And okay, so Powell can't necessarily do things about some of these problems. We are in an election year. However, so that's coming up. Could that change this picture that you've laid out?
It could. I think we're starting to see that a little bit, like I said, with the family offices maybe buying ahead of a dysfunctional election, to say the least. I mean, dysfunctional would be just a really nice way to say what's about to happen. I think it's going to be very ugly. I don't think there's really a clear winner one way or the other, to be honest with you. I'm not going to get political, but we have a lot of issues and for our economy and for our dollar, we have to be fiscally responsible, and I don't see anybody with that will. So regardless of the outcome, I think we're going to have problems with the currency. And as we go through the election cycle, I think the world is going to see a little bit more dysfunction than they've seen in the past, which is hard to fathom, to be honest with you. which is not going to give a lot of credibility to the U.S. as a leader right now.
One more point on the election. So do you think, depending on who's elected, will we see Powell remain in the Fed chair position?
That's a good question. And I don't want to go off on a whole tangent about the office being political or non-political. I think it's absolutely political. And I think we've got evidence of that over the years of it being so. I'm trying to remember where Trump stood on Powell when he left. I don't think he was really happy with him because he wanted him to cut rates, which again is probably not the best thing for the economy of the dollar going forward. But he wanted him to cut rates to spur on business, and I think Powell probably Biden probably deep down wants that too. Let's face it, presidents are elected or not elected on the performance of the economy more often than not. So I think they both want people to feel good. Whether they're healthy financially or not, they certainly want them to feel good about their finances if you're Biden going into the election cycle, and you want them to feel badly about their finances going into the election cycle if you're Trump. Neither one of them, I think, is happy with Powell, but we'll see. I don't think it matters much in the end anyway. Congress has got to do something here, not Powell.
Okay, so we'll see about that. We'll be watching that very closely. So going back to gold, so gold solidly, as you said, above 2,000 right now, and 2,000 was the level that we were kind of talking about watching in our last interview. So what is the next level to watch for gold?
Yeah, I don't think we're going to see a spike. I could be wrong. I hate to say that in public because I'm going to be wrong tomorrow. But I just don't see it, and I don't want it. Be honest with you. I think spikes are terrible for any meaningful, sustainable market because what goes up quickly comes down quickly. And that could, break all sorts of momentum if it happened. I think what we're seeing in gold is fantastic. I mean, we saw a surge, here and there, and right afterward you see some healthy profit taking. Anytime a market moves up in stair steps where you got higher highs and higher lows, that's a positive market. I don't want to run to the moon. I want it to ease its way up. I think we can be pushing somewhere around $3,000 by the end of the year, but I kind of hope we don't, be honest with you. I just want to see this continue plodding along. What I am still thoroughly convinced about, and I was last year, and I'm even more reticent about it now, determined about it now, is that gold at all-time highs is dirt cheap. Period, full stop. We consolidated for 4 years at all-time highs, not to go lower. We were building the platform to go higher, and gold is doing its job. I think it's up about 13% or so this year, roughly. Silver, as we expected, would follow and outpace, and we're starting to see that. So I think silver's up 30-some-odd% for the year. It's starting to do that. Now, it had consolidated for 4 years at 60 or 50% of all-time highs, and now we're about 60% of all-time highs. Silver's got a long way to go, and it can be explosive, especially with the supply-demand fundamentals kicking in for silver like they are right now. So I like both monetary metals. Obviously, gold is your primary, silver secondary, but I love them both in this environment. And you just sprinkle in that geopolitical risk that we're seeing worldwide, and I don't see them going down anytime soon, not meaningfully.
Okay, yeah, one more follow-up question on silver, because it has moved a lot since we last spoke. How significant is that $30 per ounce level for you?
$30, yeah. I think it's important. It's not has to happen and has to be maintained. We just saw it. It got up to like 32.50 and then pulled back into the 20s, and now it's recovering. So it's going to be volatile. That is the nature of silver. It's a thinner market. Money, the same amount of money in the silver market will force it to be more volatile than the gold market because that's a bigger market. But I think it will continue to outpace gold. We're starting to get some wind in our sails. A few years ago, we were at 127 to 1 on the gold-silver ratio. That's how many ounces of silver it took to buy an ounce of gold. We've stayed at 80 for pretty much ever, which is that magic number, and now we're down below it, right? So I expect that will continue. We'll be steadily working our way toward that 35 to 50 range for the gold-silver ratio. there's a lot of things in silver's favor. We saw like 11 years, I want to say, of surplus production of silver. And then in 2 years of deficit production, we wiped it all out, right? So that's massive. There's still more above ground silver. It's in the hands of investors, and it could come onto the market. We hit 35, 40. You'll get some tired liquidation. Like, I'm selling now. I'm going to take advantage of this. So you'll see that. But, silver's going to continue to move up. And then you throw in the demand, the green technology, solar panels, et cetera. And I think the future's super bright for silver.
Yeah, definitely. I've heard some very interesting things about solar. So I think we've been through a lot on gold and silver today. And I'll put it back to you before we wrap up, just if you had any final advice for investors on maybe what they should be doing right now.
Yeah, honestly, if you don't have your allocations to gold and silver right now, do it now. I mean, I don't act now. You're heading into the doldrums. We're kind of consolidating here. China's off the market. Good. Otherwise, the price would be much higher. And they're going to get back in, make no mistake. So the prices are low here. At all-time highs, the prices are low. And because Western investors aren't buying coins and bars, the premiums are low. Okay, once the market really takes off and Western investors are in this, you're going to see the fabrication premiums on coins and bars start going through the roof. So not only are you going to have a higher price, but you're going to pay more on top of that price to get that coin and bar. You've got the perfect storm here of low prices, low premiums. Take advantage of it. Stamping my foot. I don't know what else to say. Now is the time, I think. Take advantage of summer doldrums.
Okay. All right. Very solid advice. Thank you so much for coming on to talk about gold, silver, and other events in the market. Really good to have you.
Always good to be here. Thank you.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is Rich Checkan with Asset Strategies International. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.